Good morning, traders. This is Brad Matheny. This is the real estate and MENT rotational modeling system video. Today is the 18th of February. Happy Saturday. I have been busy making videos this morning for the last 2.5, 3 hours. So thank goodness this is, I think, the last video I need to make today before I start rendering. So where we're at in the market, let me see if I've got the proper range. Perfect. Where we're at in the market is we are entering into this last little rally phase here, maybe about 7, 8, 9% to the upside if we resolve efficiently out of this flagging formation that's taking place. The MENT rotational modeling system went bullish in early February back over here, and we are looking to resolve to the upside, then potentially move into a downside move here middle end of April, possibly bottoming back over here in July, early July, mid-July, and then rolling maybe into a flagging formation, maybe into a bit more of an upward trending. But we're going to have another, I don't know how to say it any other way. We're going to have another 5, 6 months of real, in my opinion, sideways trending. Maybe 7, 8% to the upside, maybe 8, 10, 11% down to the downside, then maybe another 6, 7, 8% to the upside, and that's going to put us into the end of the year. That doesn't seem like a whole lot, ladies and gentlemen, but it's a really good opportunity if you're a skilled trader, because you got 8, 10% up, maybe 10, 11% down, then another 8, 10% up. That's enough for us to make some decent trades and profits over the next couple of weeks and months. Now later, 2024 gets a bit more interesting. We'll get into that later. But right now I want to focus on where we're at. So the accumulation phase index, this is the S&P 500 on the top, the accumulation phase here in the middle. I expect this to continue to weaken downward through the end of March into early April. This is a monthly chart. So we got about 2 more bars of downward trending. Then we're going to see it roll higher in April, May, maybe June. Then it's going to stall back out and try to move back lower in July, August, September, October, and possibly through the end of the year with a moderate Christmas rally. I believe the Fed could be moving into a pause or weakening stance at that point, depending on what the economy is doing and what consumers are doing. I believe the Fed really is fairly close to pausing or maybe reducing near the end of the year by 25 basis points or so, maybe even once or twice by 25 basis points. But what I do expect is we are in a presidential election year cycle, early presidential election year cycle, and I think that we're going to see just sideways trading. We need to be aware that we're not going to come out of this. It's almost like this 2015-16 cycle. We're going to be kind of in this sideways mode for the next 18 months until we get some clarity near the end of 2024 with regard to the election. So be aware that this whole move could be just sideways rotation, 8, 10, 12% up and down until maybe even bigger, but until we get some real clarity into 2024. Okay? The fear index has dropped to 5.69. This is great. We could see a move back up here to these upper levels in the SPY. That would be our end of March, early April peak, in my opinion. This may push the sentiment indicator up into this, let's call it the 380 range, 384 range. Then we would roll back over. And again, this is weekly. So when we get these rolls in the market, it's going to be fairly pronounced over the next 6, 12 plus months. You're going to get a lot of sideways rotation. It's not going to be an easy market to trade, but there's still going to be a lot of opportunity there. Okay, the real estate sentiment index or cycles index has moved back into extreme hostility. I've been explaining this to you over the past month or two. This is as hostile pretty much as we can get. This is telling you that prices are stubborn. They're not coming down. The market is weakening considerably. We need to see something break in the market. And what's likely going to happen is a reversion back down into this area, like I keep telling you. Over the next 10, 12, 15 months, this would result in a 15 to 20% year-over-year price decline from these upper levels. Understand that this could take until the end of this year, maybe into 2024, before we start to see any real a measurable decline. In other words, this move could be weakening, weakening, weakening down into this area, and then finally weakening down into this area, which is where I think we're going to try to find a bottom. Depending on what actually happens in the world and the U.S., it could go a lot lower, but I'm not sure that it's going to get much below this 200, 225 area. I think this is a fairly solid basing level right now with regards to the weakening market. So real estate is really very hostile. The market seems very, very hostile. I know there's people out there buying, expecting the Fed to weaken, but I see the Fed keeping rates above 3% for most of the next couple of years. Maybe in 2027, 8, 9, we start to see something different. But understand that as long as the Fed keeps rates elevated, prices will have to decline. This hostility index will have to weaken. There is just no other way. We've never seen anything this aggressive, hostile, and that's the way I'd put it. This is a very difficult market to be in if you're in real estate, because the perceived downside move here is from 435 to about 225. That's a 50% decline just to get into this normal buying range, this normal buying range down here in 225, 250. That would indicate this move in pricing could be very easily 25, 35% to the downside over a measurable time period. 10, 20, 25, 30 months, maybe longer, depending on what the Fed does. Okay, the U.S. markets are peaking out here. Like I said, I think this is the next target. We're going to see probably a pop up into this target area here, and then it's going to roll over in April. Same thing here with the global index. We're going to pop up to this green area, which is near this high over here. Then we're going to roll over in April. And it really boils down to, like I said, the presidential election cycle. The 18 to 24 months prior to any presidential election cycle typically creates a lot of consolidation and uncertainty. So we're moving into that, whether you're aware of it or not. We're going to stay within a consolidated channel, maybe having some upward bias eventually in late 2023 into 2024 back up into this area, but I'm not expecting anything big to happen over the next 12 to 15 months. And the custom U.S. valuations trend index, until we start to see some real upward trending here, which we are not seeing, we are not going to see any big trending in the market. This is a good example here from 2018 onward. We had a nice appreciation trend. Until we get some real solid upward trending here, ladies and gentlemen, do not expect any big upward trends. In fact, if we continue to consolidate, maybe even get a little bit lower, we'll see how it plays out. But this means that we are still consolidating. We are still in a deflationary cycle trend where U.S. stock prices could rise, like we've seen over the last couple of months, December, January, February. We could see stocks, rise 15, 20, 25% in a deflationary cycle trend. That's called a price reversion, and basically means that price is attempting to find an equilibrium related to global market expectations. But until we start to see any type of big accumulation in this global valuation, valuation trend index, we're not going to see any real organic upward trending. So we might have to wait through a year or 2 year cycle here, another 12, 15 months, maybe out into this area, end of 2024 maybe, before we get into that breakout phase and start to move higher. Okay, the MENT Rotational Modeling System. This is your 401 IRA investment account, is 100% bullish. Weekly, we are bullish at 25% allocation. Daily, we are bullish at 75% allocation. Combined position, we are bullish at 100% allocation, 0% cash. We went bullish on February 3rd. We're going to let this run. Remember, this is the rotational modeling system is for those managing a 401k or an IRA or any type of investment capital. This is separate from your trading account. You are not trading in this account. This is your retirement nest egg. This is designed to keep you involved in the market in an effective manner to maximize your returns. We are currently minus 1.05% on our new trigger of about 2 weeks ago. In your trading account, we would have this is a smaller, almost only 10, 15, maybe 20% of your total investment account. This is for your trading purposes, not your investment trade account. You would be 50% allocated into stocks for trading, 25% cash reserve, 25% into metals, or alternately, if you cannot trade metals, you would be 65% stocks, 35% cash, 0% bonds right now. And this is your, this is not hypothetical, this is historical backtest results running the dual system. So remember, this is the dual system. These top two windows are the dual system. One account for weekly, one account for daily. This is how I run the system myself. So I have a smaller account with 25% of my allocation running this one, and then a larger account with 75% allocation roughly running this one. And essentially, this is the return. This is how we are doing with our MENT rotational modeling system. Throughout this rotation, we've actually come up off of these deep rotations quite nicely. Off of this was a short trigger that caught a couple of targets on the daily side. Now we're back into 100% long. We're looking for a nice long side upward move, maybe move us to new all-time highs, while the SPY here is consolidating out into a sideways flagging formation. Very important to understand that this is really for anybody who has money in a retirement account. When I'm telling you that you need to be long or short or cash or what have you, understand that that means you talk to your investment advisor, you indicate that you want to be, say, 50% short, 50% cash. What that would mean is you would start looking through your funds, finding funds that allow you to position your account in a 50% cash, 50% short position, if you can go short. If not, you might choose to move to less risky structures, bonds, or potential inverse structures to go ahead and take advantage of a short. But again, it's up to you to manage. When I'm telling you that you need to be short 50% and cash 50%, it's your job to manage those depending on who you're with and what you have with the capability. In order for you to get these types of returns, typically you'd want to be trading an SPY based type of an index or fund. So you would want to have a long SPY type fund or a short SPY type fund and roll money in and out of that. When I say cash, move that into something that's either US dollar based or bond based or has a less risk factor compared to the SPY based investment fund. So hypothetically, if you're looking at Vanguard and you see the SPY based funds have a 4.4 risk factor, and you want to try to get into something that's more cash based, look for something that's like a 1.1 or a 0.8 risk factor and move your money over to something that's less volatile to be able to kind of move away from risk and move into a cash type of a cash position. Okay. So I think we're pretty, the real estate market. Okay, real estate market real quickly. Huge increase in price reductions. Days on market here is skyrocketing. Remember I told you back over here, it's just going to be a matter of time. Well, here it is. This is the highest level we've seen in 4 years. Inventory, active listing counts are moving higher. Highest level we've seen in 4 years. Prices are still holding up in a net positive. Price reduced share of market is still positive. It was negative back over here. Take a look at this demand cycle. So now demand cycle, this orange line is reverting, and it's reverted off of this deep cycle here. So we had this big change from demand being 150% of normal ranges to being minus 50% of normal ranges. That means that we are reverting. Market demand here is at 16.62. Very interesting, folks, because we're starting to see a bit of a reversion. My expectation is demand is going to roll back downward, pricing structure is going to roll back downward as price declines and as the days on market stays in place. And this is going to be basically investors becoming, I don't want to say shocked, but let's say adverse to perceived risk related to the real estate market right now. As prices start to decline, you're going to see traders move into that. Why should I pay $680 for a house when it was just reduced $60,000, 10%? If I wait another 2 months and continue renting, I might be able to save $60, $80, maybe $100,000 on the house if we get into that type of a decline mode. So we could get into a real shock where days on market skyrocket, inventory starts to move higher, reductions continue to stay elevated, and pricing level moves into a negative year-over-year structure. Okay, next, price trends. So let's take a look at this. Price trends have moved up a little bit. That's because people are reducing, but there's still, I'm seeing price increases. Believe it or not, people are still out there trying to get the best price that they can. So it's holding up much stronger than I expected. Price reduction activity is back up to about 140%. And you can see here, this has turned positive again. Active listing change. We started to see a decrease in listings. Understand that this is a cycle trend that takes place as waves of new listing comes in, and then they stagnate. This is basically, think of it as your tachometer or your gas pedal as you're accelerating, shifting gears, accelerating, shifting gears, accelerating, shifting gears. The next phase here would be to see this base and bottom and then move back up to the upside, because we are getting essentially a broader increase in active listings. New listing count metrics, you can see here, new listing counts are moving higher over time. New listing count change is back into positive. Share of market is positive. And then lastly, let's come over here. The heat rank. The heat rank is weaker overall. This is telling us that the markets have now moved into a very, let's call it a very narrow malaise. Very little real demand. The heat rank is weakening. That's telling us it's getting softer and cooler in the market. I think you're going to find over the next 5-6 months, this really starts to just tank downward. The tightness index, boy, look at this. I don't know how to explain this any other way. This is essentially a loose market. It's minus 101%, roughly, ladies and gentlemen. You can see back over here, we had moderately strong, tight market. Okay, how tight is it? Well, the demand is still there. Prices are still solid. We're okay. We're okay. Look at what's happened here. We've just collapsed. Okay, this is a real concern with regards to tightness, because this is a very early sign that prices could start to collapse much more aggressively over the next 5-6 months, depending on what the Fed does. Inventory strength has started to collapse as well. You can see here that we've moved from this kind of a upward channel cycle into this downward channel cycle. If this moves down into the minus 10% area, this means you're going to start to look at negative year-over-year price functions probably by May, June, July. And then, of course, we have seller desperation here. Seller desperation is weakened. It's consolidated. You can see we've got this, I hate to say it, but it's just kind of a stalling pattern. I really think that we're gonna see a big seller desperation mode come the end of 2023. But you know, pay attention here. This tightness ranking is telling you that the bottom is starting to fall out. The inventory strength is weaker again. This could move down into minus 6, 7, 8, 9, 10 territory, and that would prompt seller desperation to move quite a bit higher. So understand that we are weaker yet. We're starting, these spikes correlate with these inventory strength numbers. You can see, and then we're starting to get a little bit of an inventory strength number here. That's off of this peak. Wait until this rolls down. Boy, oh boy, it's going to be a very interesting move in the markets. Okay, that's it for the update this week. Go to ment.com, follow what I'm doing, pay attention. I really want to help you. I'm trying to advise you properly how to stay invested in the markets. You can see the MENT Rotational Modeling System is performing extremely well, and we're about ready to go through a 16, 18-month period where I'm telling you, the wannabes who don't know what's coming are going to be struggling. So if you really want to pay attention to what's going on, come over here. Come and join the Expert Growth member subscription. Pay attention to all of my research, and let's turn the next 10 years into the best opportunities you guys have ever seen. All right, guys. Talk to you later.